Hello, in this lecture we're going to go over a couple more problems. These are going to be shorter test type problems. They're going to be shorter in length, types of problems that could be in a multiple choice format. And in order to do this, I'm going to pull this to the left over here and take a look at this other Excel sheet. This is an unrelated Excel sheet to this problem, but it's good to have something like this open in order to have some type of cheat sheet, either when you're practicing and or if it's available when you're taking the test. To have it open when taking the test, it'll tell us things like which accounts are assets, being the green in this case, liabilities, equity, income, and expenses. And we know that the debits in this case are represented in non-bracketed numbers, and the credits have bracketed numbers. All right, so if we go through this first one is a bit longer, but this would be a long multiple choice type question, could still fit in a multiple choice type question. So we have the store opened on March 1st. Of the current year. During March, the following transactions occurred and were recorded in the company's books. So we have this information. Now, if there is a problem that's this long, I'm going to skip to the bottom at this point and see what they want first, and then go back and look at these questions and these transactions. So based on this information, net income for March would be what? All right, so net income is what we're looking for. We know that net income is calculated as revenue minus expenses. So we're looking for things that are affecting revenue and expenses as we go through this. Now I'm going to journalize each journal entry and think about that. Is this affecting revenue and expenses? So the first one, the owner invested $42,000 cash in the business. So if we think about the journal entry related to that, we would say, well, that cash is cash affected. Yes, cash has a debit balance represented by the fact that it doesn't have brackets around it. We need to make it go up, so I'm going to do the same thing to it, which in this case would be a debit. So I'm going to say cash is going to go up with a debit, and that's going to be $42,000. And then the credit is going to go to capital. The owner put it in there. Capital has a credit balance. We're going to credit it again, making it go up by the amount that the owner invested. So we're going to credit capital. And so I'm going to make the credits a negative number. That's the debit and the credit. So that one, is there any effect on net income? No, because neither of those are revenue type accounts or expense type accounts. Therefore, no effect on net income. Now, we could think of net income as basically its own kind of T account. It's not one account, but we can kind of calculate it as a T account and think about it that way. So we could say net income over here, and when we select net income or have items related to net income, we can put them in this area over here. So I'm going to merge these. I'm going to put the debits here and the credit here, and I'm just going to make a T account like we're familiar in seeing on this type of item, and we'll emphasize the T-ness by putting some border here. Now remember, this is not one account. Net income's not one account, but how do we calculate net income? It's going to be the credits of revenue, which are always credits, and they basically only go up, minus the debits of expenses, which are basically debit balances and always go up. That's how we calculate net income. So any revenue accounts we can credit, basically, and any expense accounts we can debit on this side, and that's one way we could say the credits minus the debits will be what net income will be, or revenue minus expenses, just said in a different way. All right, so the owner's contribution of $117 of equipment to the business. All right, so now the owner put equipment into the business. So I would usually ask, is cash affected? No, we put equipment in at this time. So equipment is put in. Equipment's also an asset, and it has a debit balance. We're going to make it go up by doing the same thing to it, which in this case would be another debit. So I'm going to debit equipment, and that's going to be 117,000, and then we're going to credit something, and again, who put it in there? The owner put it in there. So the owner's equity is a credit balance account. We're going to make it go up by doing the same thing to it. In this case, would be another credit. Now, this one's a little tricky. We might have thought, well, income should be affected because of this equipment, possibly, maybe, you might think that, but notice that the equipment is an asset, and we could see that from our trial balance up here rather than an expense account, not equipment expense, and therefore nothing down here, no accounts on revenue and expenses are affected, no effect on net income, therefore. Next one, company paid $3,007 cash to rent office space for the month. All right, so then I would usually go over here, is cash affected? Yeah, we paid cash. So cash is a debit balance, we're going to make it go down by doing the opposite thing to it. So I'm going to copy that. I'm going to skip a line and put it on the bottom and say that's going to be a credit. I'm going to put it in the credit section, and that was for the company paid $3,700 cash. Then we're going to debit something. And that's why I usually think about the credits first. Debit something. What are we going to debit? An expense this time. So we're going to have rent expense. Now I don't have rent expense over here. We don't have it in this particular trial balance, but we can see that they're debit balance accounts here by the fact that they do not have brackets. And therefore we know that they only go up, and therefore we have to debit rent expense. Now this one, I'm going to highlight this one and say, hey, that's one that affects net income, because net income is revenue minus expenses. So I'm going to put that in like our T account type thing. This is actually a debit side. This is an expense that happened here, and that's what's going to happen to our net income. And I can try to sum up the net income now just to see what the net income will be as we go. If we sum up both sides of this T, we get total debits and total credits. And right now, of course, the debits are beating the credits by that 3.7. But at the end of the day, it's going to be a credit balance. Right now, it's a debit balance. But hopefully, we have more revenue, more income than expenses. And therefore, the credits should be winning at the end of the day, just like it is here. All right, so let's see the next one. What do we got next? After the rent, then I'm going to just go ahead and highlight these so that I've done those. Then we've got the company received $33,000 cash for repair services provided during March. Okay, so is cash affected? Yes, and we received cash, keyword being received cash, so apparently we do services, so that's good to know. And then we're going to increase that by doing the same thing to it. We're going to debit cash. So I'm going to go over here and debit cash like so, and the amount will be for $33,000 on the debit side, $33,000 it should be. And then we're going to credit something, and the thing we're going to credit, why did they pay us? We did work. And we did it in the same time period, therefore we are going to credit revenue, the account representing us earning money. So we're going to say earning income, earning revenue. So we're going to copy revenue, and again, we could call it revenue, we could call it fees earned, we could call it income, whatever we call our revenue account, that's what we're going to be selecting here. And so that's going to be the credit. We know that revenue minus expenses, that's going to be affecting net income. That's a credit to our net income type T account, which isn't actually an account, but acts in a similar fashion. And that's that one. That's number 3. So then let's go to number 4. It says company paid $7.9 for salaries for the month. All right, so is cash affected? Yep, we paid salaries, and therefore cash is going to go down because we paid cash. Cash is a debit balance. We're going to make it go down by doing the opposite thing to it, which in this case is a credit. So I'm going to put that on the bottom, and we paid $7.9, so I'm going to say $7.9 on the credit side. We're going to debit something, and I'm going to highlight this one too because that one was in our T account. And the debit's going to be what do we pay? Wages or salaries or some type of expense. So expenses are going to be down here. I have one called wages. That'll work for us. We just need to see the effect on net income, so we're going to debit the expense in this case. So we're going to highlight that one because it's going to affect our net income. And it'll be on the debit side, and that will be the 7.9. Notice what's happening in our T account. It had a debit and then a credit and a debit. So this minus this plus this. So we got credits winning of 24. So notice our T count is in hopefully where it will stay with the credits being revenue type stuff, beating the debits being expense type stuff. All right, so then we'll highlight that one. That one's done. The company purchased 4.7 of services to customer on account. Provided 4.7 of services. All right, on account. So is cash affected? No, in this case, because it's on account, meaning we did work, we provided services, that's what we do, but we didn't get any cash yet. We're going to get it in the future, and therefore we have a accounts receivable. They owe us money for work that has been done. It's an asset as well. We're going to make it go up by doing the same thing to it, which in this case would be another debit. So we're going to debit AR this time for 4.7, and we're going to credit something. What are we going to credit? Well, we earned, in this case, revenue. So once again, revenue is affected even though we didn't get the cash yet because we have earned it, and that means we record it in accordance with the revenue recognition principle. All right, so that's going to be 4.7. That affects net income. I'm going to highlight that. That one affects net income. So we're going to say that's a credit to our net income type T account over here. So it's a credit. And what happened? Well, the debits add up to 11.6. The credits add up to 37.7. and the difference being credits winning of 26.1. That is what our net income is at this time. All right, so I'm going to highlight this one. We've completed that. Then the next one, the company paid cash of $2,002 for monthly utilities. Okay, so is cash affected? Yeah, we paid cash. So cash has a debit balance. We're going to make it go down by doing the opposite thing to it, which in this case would be a credit. So we're going to credit cash. I'm going to go down here. I'm going to skip a line, put it on the bottom because credits generally go on the bottom, go on the credit section. And we are looking for a credit of 2.2. And then we're going to debit something. What are we going to debit? Well, we paid 2.2 for utilities. So utilities is what type of an account? An expense account. Utilities expense. So we're going to go down here, utilities expense. And that's because, of course, we used utilities in this time period. That's why it's an expense. Utilities isn't inherently an expense because if we use the utility to produce assets, like we will at a later time, it won't inherently be an expense. But for now, it's going to be a utilities expense because we've consumed it. And therefore, this one's going to affect our T account. So I'm going to go and do that. And we have our net income T account is now going to be debited by the utilities. So here we have this. And what's the effect? That's the effect. That's our debits. Here's our credits or our expenses and our revenue. And the difference being 23.9 at this time. Going to go ahead and highlight that one. Then the next one, the company received 4.8 cash in advance of providing repair services to customers. All right, so is cash affected? Yep, we received, that keyword being received again, so I'm going to say cash is affected. And then we're going to go down here, we're going to skip a line, and we're going to put it on the debit side. Cash is affected. We'll put that up top for 4.8, and then we'll credit something for 4.8. And now we received cash because of we're going to do work. But notice the key word here is we're going to do work and we got paid in advance, meaning we got cash, but we haven't earned it yet. So normally we would like to credit revenue if we had earned it, but if we don't do the work, then we have to pay the cash back or we have to do the work. So that means it's going to be a liability. We're going to call it unearned revenue in this case, meaning liability has a credit balance. We're going to make it go up by doing the same thing to it, which in this case would be another credit to the liability. Notice no effect on net income. That's the kind of, if you don't do the journal entries, you may not get that one. You might think that should be affecting net income. So you want to think that through, and the trial balance can help. Obviously, we could do this faster if we can visualize it in our head a bit faster, but this is the longer process. It is good to put down the journal entries because that'll tell you, more for sure whether income or expense account is affected. Okay, and then the owner withdrew 6.7 for his personal use. All right, so then the owner took out some money. So is cash affected? Yeah, it's going to go down for the company. It goes up for the owner, but down for the company. So we're going to credit the cash account for the amount that the owner withdrew of 6.7. We're going to debit something. What are we going to debit? We're going to debit draws or withdrawals. So that's going to be the debit, and that is a equity account, not an expense or revenue account, therefore no effect on net income from that transaction. So looking at this now, of course, now we have our answer here being net income of 23.9. We did it with this T account type of format. That is a format that can work. If you wanted to just kind of highlight the accounts that were affected, whether they are expenses or revenue, that would be another type of way we can do it. We could say that the income, if we want to see it more like a income statement, that might make sense to people. We can say income equals the income stuff that happened, and I'm going to make it a positive number in this case. Instead of debits and credits, we're going to say that revenue and that. So the 33 plus the 44,007, that's how much revenue we got for the period. Now let's add up all the expenses. So less expenses. And so I'm just going to add them all up and group them into one expense category. And I'm going to say, well, expenses, we had rent expense plus the wages expense plus the utilities expense and enter. So all the expenses add up to 13.8. Therefore, net income is calculated as revenue minus expenses. And that should come up with the same net income as we have in our T account over here.